Most people think the retirement dream is simple. Work hard, max out your 401k, retire with $1 million, maybe two, maybe $3 million, and then finally relax. But there's a twist that almost nobody sees coming. You can do everything right for 30 or 40 years, save consistently, invest responsibly, avoid lifestyle inflation, and still walk straight into one of the most frustrating tax traps in retirement. Not because you made a mistake, not because you didn't plan, but because of how required minimum distributions and Social Security interact inside the tax code. And once you understand how this works, it completely changes how you look at retirement tax planning. So today, I'm going to break this down simply: what the tax torpedo actually is, who it really affects, why it feels so unfair, and how you can legally reduce it without complicated strategy. Because this isn't about fear, it's about control. And if you're enjoying the video so far, make sure to hit that like button and subscribe to see more videos like this. Let's start at the beginning. When you contribute to a traditional 401k or IRA, you get a tax deduction today. It lowers your taxable income, it lowers your current tax bill, it makes saving easier, and that money grows tax-deferred for decades. But here's the part that's easy to ignore when you're 35. That money has never been taxed. The IRS is patient, and starting at age 73, it wants its share. That's when required minimum distributions, RMDs, begin. Your first required withdrawal is roughly around 3.6 to 4% of your account balance, and that percentage increases every year after that. So, if someone retires with $2 million in traditional accounts, their first required withdrawal might land around $75,000 to $80,000, even if they don't need it. Even if they'd rather leave the money invested, they don't get to decide anymore. And that withdrawal counts as ordinary income. Now here's where it gets more interesting. That income doesn't just affect your tax bracket, it affects your Social Security too. A lot of people assume Social Security is tax-free. It's not automatically tax-free. How much of it becomes taxable depends on something called provisional income. That's basically your other income, like IRA withdrawals, plus half of your Social Security benefits. For married couples filing jointly, once provisional income crosses $32,000, up to 50% of Social Security becomes taxable. Once it crosses $44,000, up to 85% becomes taxable. Notice something? Those thresholds are not very high, which means many middle-income retirees pass through this zone. And here's where the surprise hits. It's not just that Social Security can be taxed, it's how it phases in, because that phase-in creates what feels like a hidden tax bracket. Let me make this painfully simple. Imagine you're in the 12% federal tax bracket in retirement. You decide to take $1 extra out of your traditional IRA. Because of how Social Security phases in, that $1 can cause up to 50 cents of your Social Security to become taxable too. So instead of being taxed on just $1, you're effectively taxed on $1.50. Now apply 12% to $1.50 instead of $1. That's not 12% anymore. That's closer to 18%. And once you layer in state taxes and other small phase-ins, your effective marginal hit can land somewhere in the high 20s. Now imagine the same thing happening in the 22% bracket. If $1 of IRA withdrawal pulls in 85 cents of Social Security into taxation, you're now taxed on $1.85. Multiply that by 22%. Now you're looking at something north of 40% on that slice of income. Add in Medicare premium increases in certain cases, and suddenly retirees are saying, "Why does it feel like I'm paying more now than when I was working?" There is no 46% bracket printed on the IRS chart, but in that specific phase-in zone, it can absolutely feel like there is. That stacking effect is the tax torpedo. Not a new bracket, just overlapping rules. Now here's the part that surprises people even more. This does not usually hit retirees with very low income. They stay below the phase-in thresholds. And it often doesn't hit very high-income retirees either, because their Social Security is already 85% taxable no matter what. There's no phase-in left to trigger. The group most exposed? The disciplined saver. The person who maxed their 401k for decades. The person who retired with a 7-figure nest egg, mostly inside traditional pre-tax accounts. The person who plans to live on Social Security plus moderate IRA withdrawals. Not ultra-wealthy, not struggling. Right in that responsible middle. And that's why it feels unfair, because they did everything right. There's another layer that makes this even more important. When one spouse passes away, the surviving spouse switches from married filing jointly to single. Tax brackets compress dramatically. One Social Security check disappears, usually the smaller one, but the IRA balance often remains largely intact. So now similar RMD amounts are hitting narrower tax bracket. In many cases, the surviving spouse ends up in higher marginal brackets than the couple ever experienced together. That's something very few people plan for, but it's baked into the system. And then there's Medicare. Medicare Part B and Part D premiums increase once your income crosses certain thresholds. This is called IRMAA. If your income goes just $1 over a threshold, your premiums can jump for the entire year. So now your IRA withdrawal isn't just affecting income tax, it can increase healthcare costs too. Individually, each of these rules seems manageable. Stacked together, they create friction. And friction compounds over time. So what can you actually do about this? Here's where the opportunity shows up. There's a powerful window in retirement that many people overlook, the years between when you retire and when RMDs begin at 73. During that window, your paycheck stops. You may delay claiming Social Security, and RMDs haven't started yet. For many people, those are the lowest taxable income years of their entire adult life, and that's where strategic Roth conversions can become incredibly powerful. Instead of waiting until 73, when withdrawals are forced on you, you can gradually move money from traditional accounts into a Roth IRA while you're in lower brackets. You choose the amount. You control the bracket. You decide the timing. You don't have to spend the money. You're just changing its future tax treatment. Even converting a moderate amount each year over 8 to 10 years can significantly shrink future RMDs. Smaller traditional balance means smaller forced withdrawals. Smaller forced withdrawals means less Social Security pulled into taxation and potentially fewer Medicare premium surprises. Same total wealth, more control over how it's taxed. Zooming out, the bigger lesson here isn't that traditional accounts are bad. Traditional accounts are powerful tools. For many families, that upfront tax deduction is what allowed them to save aggressively in the first place. The real risk is going into retirement with everything in one tax bucket. If all of your savings are pre-tax, the IRS dictates your schedule once RMDs begin. But if you have a mix, some traditional, some Roth, maybe some taxable brokerage, you gain flexibility. In a year when you want to keep taxable income lower, you can draw from Roth. In a year when markets drop, you can convert at lower values. In a year when you're close to a Medicare threshold, you can adjust withdrawals. Flexibility reduces stress, and flexibility comes from tax diversification. Now, to keep this realistic, this isn't catastrophic for everyone. If you expect to remain permanently in lower brackets, the torpedo may not hit hard. If you already have large guaranteed income that pushes most of your Social Security into taxation anyway, the phase-in effect may not apply. This is not about panic. It's about awareness. Because once RMDs start, your flexibility narrows. Before they start, you have leverage. And retirement planning isn't just about growing the largest number possible. It's about deciding when and how that number turns into income. The goal isn't to avoid taxes forever. The goal is to decide when you pay them. You worked decades to build your retirement savings. The last thing you want is to feel like the system is dictating your withdrawals instead of you. And if you want to learn more about retiring, make sure to watch this video.